Before we begin, a quick disclaimer. This podcast is for entertainment and information purposes only. It should not be relied upon as a base for any investment decision. Nothing here is a solicitation or an offer to buy or sell any security. Either the host, guests, or clients of either may own securities discussed on this podcast. Record. And welcome to another episode of the Special Situations Cast. Today I have a very special guest, Javier López-Bernardo, and he's a portfolio manager at Brightgate Capital. Javier, welcome.
Thank you very much, Bram, for having me here.
Yeah, no, it's my honor. And could you maybe tell us a little bit about yourself and what you do at Brightgate Capital? Because I understand you have like multiple functions, and what got you into investing?
Yes, well, Brightgate Capital is an asset management boutique based in Spain. We are based in Madrid, right? I've been working here for 5 years, and last year we launched a balanced fund, equity and high yield, right? Which is called Brightgate Focus, right? Before that, I've been working in Brightgate as a fixed income analyst. It has been 4 challenging years, to say the least. And before that, I was finishing my PhD in London. I did a PhD in economics, financial microeconomics, to be more precise. And then I decided that asset management made a lot of sense because you have to read a lot and to speak very little, I would say. And I think that made a lot of sense to me.
Okay, so you like to read a lot. And do you still analyze for high yield as well, or you're now completely over to the...
Yes, we have a very broad mandate. Okay,
Mm-hmm.
So we can invest across asset classes. So when we start looking at a company, we start from scratch, I would say. So we can take a position in the equity of the company, in the high yield convertibles preferred, and so on and so forth. So we don't have any specific target for an equity allocation, let's say. So it's just based bottom up, right? So if we decide that the high yield bond of that company makes sense, then we will go for the debt of that company rather than the equity. Okay, so for instance, our exposure to the thermal coal space in the US, which is done through 2 coal producers, Alliance and Consol, right? We did it through the bonds of these companies because we thought the risk-reward proposition was much better, and the yield towards of these bonds was generous enough to invest in this instrument.
Oh, that sounds interesting already. Were they trading like below par as well? Because you think that's common in that space, or just high yield?
Yes. Some years ago, I mean, when you had the 2017 and 2018 coal cycle, it was a very short cycle, and it was mainly driven by the closures in the Chinese space, right? I mean, these companies were fortunate enough to issue new debt, okay? And this debt until 2019, more or less, is, if I remember correctly, this debt was trading even well above par. I remember Consol bonds. I remember these bonds were trading at some point at 110, right? And then over the last couple of years, even before the Corona crisis, right, both bonds have been trading lower and lower. And at some point, for instance, in the case of Consol, they have reached 45. So we think it's a very nice proposition. You are creating the company at a very low EV.
Wow. So if they don't go completely out of business, it's interesting space.
Yes, I think it's a tough call, right? Because all of us know that coal is in secular decline, so no question about that.
Mm-hmm.
But I think there has been some overreaction in the sense that people think that legislation, regulation, and politics influence a lot the coal space, and I think most of this influence have come from gas. So all the negative impact that we have seen on the coal space over the last 4 or 5 years, it's because natural gas prices have been very low, and to some extent we expect them to be quite low in the future. I mean, one of the lessons of the last few years is that there is a lot of gas, right? And there is a lot of cheap gas.
Sure, yeah. I think some came offline when there was such a glut of oil in the beginning of the pandemic, maybe March. Maybe that helped a little bit. But yeah, there's a lot of gas and more to come. Let's see. Hey, I've looked at the companies you're investing in, and yeah, I really liked your portfolio so much. It's very unusual for me that I think, oh, I could have bought that one. Oh, I could have bought that one. And I mean, like that the general thesis attracts me because, of course, I don't know them all in a very detailed level. But I'm curious, like, what is your general philosophy, or how do you got to those companies that you're investing in?
Yes, well, I would say it's a three-branch approach. Most of these points are not novel at all, I would say. And the last one, maybe it is. So, well, the first one is concentration. Probably most of your speakers are very concentrated managers. You know that in Europe, because we have to follow UCITS rules, I mean, you can have a hedge fund, right? But most of us, because of commercial reasons, we have to do our strategies in a UCITS format. So that constrains us a little bit in terms of how far, in terms of concentration, we want to go, right?
You have to have a number of positions, maybe. I don't
exactly.
actually
I mean,
know the number.
Your top position cannot go higher than 10%. Your number of positions more than 5% cannot go higher than 40%, and so on and so forth, right?
Yeah.
So it means that sometimes, as we will speak in a while, for instance, in the case of our memory makers, maybe I cannot get a position of higher than 10% in Samsung, but I can diversify that position in Hynix and Micron, which are basically the same, I would say, right? So that's the first point, that it's as concentrated as we can. Okay, so and we want to be for the long haul, right? The second point, I would say that we look for companies with no debt. And when I mean no debt is no debt, is not like, okay, for this sector 3 times EBITDA is okay, right?
Okay.
No, when I mean no debt is no debt. Okay, I have the theory that most, even the algorithms, right, and many analysts, when they do screenings, they do it in an unleveraged basis, in the sense that they take the total assets of the total equity of the company, right, and they look at the net profit, and then they do a kind of return on equity, right? When you have unlevered companies with a ton of cash, of course that cash is a burden for your returns, right? And they don't score very well. Sometimes most of these companies, for some reason, they become more generous with the shareholders, or they distribute a special dividend or whatever, and they screen much better, right? Mm-hmm. So you have many examples of that. I mean, even in very big companies like Apple in 2016. I mean, you could say that, of course, that Apple there has been a lot of debate about Apple, right? I mean, 2016 it was a bit murkier, but I think the principal reason why Apple was so cheap is because the large cash in its balance sheet. Curiously enough, Apple has been distributing cash, so you could say that now, I mean, it has still a ton of cash, right? But in terms of valuation and in terms of risk reward, you could say that Apple is a less attractive investment than it was in 2016, right?
But I think they got a lot of pressure from ICANN, I think, at that time, right?
Exactly.
Yeah.
Exactly.
Just for cash.
So, for instance, Samsung, I think it's having the same problem, right? It doesn't screen very well when you do very basic numbers. Okay, but you know that the cash in the balance sheet of Samsung is a strategic decision, and that could change rapidly, I would say, right? So that's our second point, no debt, right? And the third one is that when we approach companies, we normally value companies in a different way. Okay, we never use free cash flows. Okay, we never use dividends, and we rarely use. And I can now elaborate on this. And we rarely use multiples. Okay, so the way we value companies is through the residual income model, which says that you basically have your assets in your balance sheet, right? And then you have to bring forward in time, right, your future economic earnings. Economic earnings are those earnings that are earned about the cost of capital. Okay, so if you have, let's say, a cost of capital of 10% and your ROEs are 10%, right, then your investment is basically book value, right? This evaluation approach is very common in financials. I mean, when you look at the banks, right? Many people say, I mean, what's your return on equity, and what's your rate of discount, and what's then your price to book value, right? And that's all.
Mm-hmm.
But for some reason, it's not applied to the rest of the companies, right? In theoretical terms, I mean, when you do the math, right, the residual income model and the free cash flow model are exactly the same, right? So it's basically the same. So if you had, in an ideal world, all the parameters to conduct your valuation, okay, and they were given, right, you would obtain exactly the same number for your valuation, right? But as you know, as Jogi Berra said, in practice and in theory, things are different, and blah, 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 right?
Yeah.
The problem in practice, right, is that the free cash flow model faces many hurdles that the residual income model doesn't have to, right? For instance, imagine a company that is investing too much, like the semiconductor companies, like TSMC, Samsung, Intel, Micron, right? Most of the time, they don't generate any free cash flow, right? So how do you evaluate these companies? So you have to make this fiction that you are projecting free cash flows up to 2022, 2023, 4, and so forth, right? But of course, that's a bit of a challenge, because it means that you are projecting very far in time, right? So there is some degree of uncertainty.
You have something, if you got something wrong, it's, it's completely, your valuation is completely off.
Exactly. With the residual income model, on the other hand, you are already giving some value to those investments. So if Micron is making big investments, okay, and they don't generate free cash flow, but they are generating economic profit, then the residual income model tells you, well, you should bring this value onto your balance sheet, right?
Mm-hmm.
And it's valuable, right? Those investments are worthwhile. I would recommend to your listeners, if they are interested in a very technical reading of this approach, to read Stephen Penman, which is a professor at Columbia University. Okay, he has written a couple of books. One of them is Accounting for Value, which is a small book, and I would say it's by far the best book on value investing I've ever read. And I can tell you I've read quite a few. So it's a great book. And the other one is a textbook, which is called Financial Statement and Security Valuation, right? By Stephen Penman as well, which you go into more detail of this method, right? So, and this is how we do things, right? So when we approach companies, we try to understand the historical performance,
Mm-hmm.
okay? So that means we go 10 years in time, roughly, sometimes less, sometimes more, right? And that implies, of course, that our companies most of the time have to be mid-cap, large cap, because in that sense you have a long historical track record. For us, the long historical track record is something that we can anchor on because it's public information, it's cheap to obtain, right? And it gives you a lot of clues, right? So it's basically the result of thousands of decisions over the last decade. So it's a lot of valuable information. So when we have that and we clean the numbers, okay, and we look at the numbers from this lens, right? Then we can assess whether this return on the assets, return on net operating assets, right, is sustainable or not.
Cool. I actually haven't read the books that you recommended, so I'm definitely going to check them out. Columbia University is the
The Holy
University
Grail.
of the Value Investor. So super interesting. Maybe to stay a little bit at a high level before we dive into real companies, which I always love the most. How are you looking at the economy right now? Because we're kind of in a weird spot. Markets are doing, well, great, and the economy doesn't feel that way. What are your thoughts?
It has been a very challenging period because I say that the divergence between the fundamentals of the companies and the valuations is higher than ever, right? I mean, we have never seen such a time when you have businesses. I mean, probably just for 1 year or a couple of years, right? Not forever, right? But with a decline, a very profound decline in earnings, right, and valuations going higher and higher, right? I think one of the reasons, which is very little acknowledged, is that the unequal income distribution makes to be valuation so high, right? I mean, probably many of your listeners will be thinking that, of course, central banks are the main culprit behind it, and I wouldn't disagree. But I would say to these people, right, that I mean, we have had low interest rates before, for instance, in Japan, for more than 3 decades now, right? For a little bit less than 3 decades, and in Europe, yes, for over the last decade, right? And valuations in Europe until very recently, and Japan until very recently again, have been very low, right? So central banks are not the only recipe, right, to high valuations, right? And I think that the corona crisis, this K-shaped recovery that we are hearing in the news, is making the income distribution even worse, right? When you have very unequal income distribution, it means that consumption levels are low because high income earners cannot spend all their marginal propensity to consume is very low, right? And they have to park these savings in some kind of asset, right? And that's coupled with a very low real investment environment, right? Nobody invests anything right now in the Western world. China is a different story, we know. And I think that has created that there is a ton of savings out there looking for vehicles to invest, and that's why valuations are very stretched. You could argue that whether this is going to be something secular for the next decade, I couldn't tell you, because that's basically a political decision, whether this wealth inequality is sustainable or not. But I certainly think that is one of the main drivers of stock valuations right now.
Yeah, that's interesting. I think that's a great point that you make, that Europe and Japan didn't have those high valuations and still don't really have those. It kind of destroys that point that low interest rates need to result in high stock prices, unless all the Japanese and Europeans are investing in the US, which to an extent is probably the case. But
you're very right.
Yeah, it's a strange world. And what are your thoughts on inflation? Could that maybe force politics a little bit, that or solve some of the inequality?
I don't see any inflation in the short term. I mean, I don't make investment decisions based on inflation. So the stocks we are going to talk about, they don't have any inflation outlook baked in, right?
Yeah.
But my views on inflation are much stronger than in any other macroeconomic topic. I mean, we at this stage, the amount of evidence that inflation is basically caused by wages, right, and not by monetary policy decisions, I think is overwhelming, right? We have had an unprecedented easing in monetary conditions, not just in the US, right, but worldwide. And I would say again, look at Europe and Japan, right, over the last 2-3 decades, right? with unlimited quantities of QE, and there is no inflation in the horizon, right? And because there is no inflation in the horizon, it's because wages are low and because the levels of debt in the system are very high, right? I recommend your listeners to look at the theories of Hyman Minsky and even Fisher, which is called, and Richard Koo, which is a very prominent economist, right? And with a lot of very nice books. All of them basically argue that deflations occur because you have a very high level of debt in your system, right? And all of your actors in the system are trying to repay that debt, and that creates a further spiral, right? Which if you don't have enough fiscal policy, then you cannot get out of it, right? So I'm an advocate, very much so, of the debt deflation theory, because I think that theoretically it makes a lot of sense. And also from a practical perspective of what's going on in the world, I think it makes a lot of sense as well.
Okay. Well, with that, let's dive into some real companies. One that I think is really interesting position you have on is Lukoil. And I did an analysis of a large oil companies. It's a while back, but it was like by far the cheapest on a price per barrel basis, or maybe it was a different Russian one, but it was definitely either Lukoil or a Russian peer. Why do you like it so much? And what got you into Lukoil?
Well, I know you are an expert in the energy space, Bram, so probably we can talk a lot about it. But if you look at the energy space and you are looking for quality oil exposure, right?
Mm-hmm.
As I said, I think there is a ton of gas, and I think gas is structurally a disadvantaged sector, and full stop, right? Maybe gas will go $4, $5, $6, I don't know, in the short term, but I would say that over the long term the outlook is not very promising, right? Oil is different, okay, because as you know, oil is very difficult to get, right? So I wanted to get in the energy space as much as an oil exposure as I could, and no gas exposure. So that's the first thing, right? The second thing is that it's very difficult. It's extremely difficult to find high quality good assets in the oil space. First of all, because most of these assets are held by government companies, Saudi Arabia, right, Iran, Iraq, so on and so forth. And second, because most of these assets are held by the majors, but the problem you have with the majors is twofold, right? First of all, now they have a ton of other assets, which are basically renewable assets, right? And I think it's not the right time to invest in these assets. I mean, probably we will have a green economy, but when all of these guys with no previous expertise are investing in the same space at the same time, we know that probably forward returns are going to be bad, right?
You're referring to like this. There's a huge European trend, I would say, which is for like the Shell and I think the French one is.
I'm talking about Total, BP, Shell, Equinor, right? Or any and even Repsol, the Spanish company, all of these guys, right?
So they're all buying like wind farms and solar farms or building them. Yeah, and then they're investing quite a lot in it. At first, it wasn't that much, but now it's a lot. And at Shell, even compensation is tied to it now. And I think it's in part regulatory driven. There are some strange European regulations that drives it. But yeah, just to clarify for the listeners, but please, I can understand your question how great are the returns on that investment going to be.
I'm not an expert in renewables, so I cannot say, but the ingredients, I mean, when you look at the general picture, right, that doesn't look very promising when all of these guys are doing the same thing, right?
Yeah.
It looks like the oil sector in 2013, right? Everyone investing in ultra deep water, paying $700,000 per day.
It feels like a really crowded trade.
Exactly.
Yeah, And
exactly. And they don't have any expertise, and full stop. They will probably develop it. I'm sure, because they have a lot of resources. But anyway, even if you think renewables are going to be a great thing, and the investment is going to be a great thing, if you want to invest in oil because you have some view on oil, whatever, right? Then you want to have exposure to oil, right? Not to renewables. So you want to have a pure play. So that means that basically the Shells of this world, Total, Eni, BP, are basically out of the picture.
Yeah.
Well, the second reason is that they have tons of gas as well. Shell and BP, they have been investing in gas assets over the last 5 years enormously, right? And I don't want it's liquefied gas, right? So it's a bit different than pure gas, right? But anyway,
maybe to be the advocate of the devil here. Like I understand that like great oil assets are probably a lot more unique or harder to get these days. But some people say like usage of oil is going to decrease. And while for gas, maybe there's a little bit of a future because it's so flexible and it can be used next to renewables. Do you think that advantage is outweighed by that it's so abundant?
Yes, I certainly think so. That's a very nice summary.
Okay, that's too bad.
That's one problem, as I was saying, and then you have players like Exxon and Chevron, right?
Yeah.
Which they have been more steadfast in the oil investment. The problem with Exxon is that they are still committed to invest in shale, and shale assets are horrible. I mean, it's no question about it. They haven't been able. Exxon is very straightforward about it. Just to let you know, I mean, when you look at their annual reports, the amount of information per segment they provide, and in terms of the return on capital of every business, is phenomenal. So it's a bit of a mismatch of what Exxon says in the annual reports. They are comparing Guyana versus the shale, right? Which they are very totally different assets. The offshore assets much better. And when you look at the return on capital, that has been the story, right? But then they are still committed to invest in shale, which for me is a bit strange, right? So of course, Exxon has premier assets. The refining system, Exxon's refining system is phenomenal, is unparalleled, right? But of course, you have the capital allocation decisions, which have not been very good. Then you have the Canadian players, okay? And the Canadian players have been good guys, I would say.
Yeah.
But the problem is that the assets are not so good. They are much better than shale, of course, but oil sands need high oil prices, right? And when you look at the returns over the last decade of players like Suncor and Imperial Oil, I mean, Suncor, you have a full cycle, right, with oil prices at 120 and oil prices at 40, and Suncor on average has obtained a return on capital of 9%, right? Imperial Oil a bit better, 11%, because Imperial Oil has had more downstream exposure. The refining system of Imperial has been bigger in relative terms than Suncor. So and because refining has been a very good business over the last decade, Imperial has been a better investment over the last decade than Suncor, of course. But of course, they are not. They are well-managed businesses, but they are not top-notch assets, I would say, right? And then you have Lukoil, right? Lukoil, the first advantage of Lukoil is that it doesn't have any debt. I mean, it's minimal, right? It has increased a little bit over the last 9 months because of COVID, right? But when I mean zero is zero, so Lukoil doesn't have any debt. The capital allocation policy has been phenomenal. I mean, when you look at 2019 and you take current Lukoil prices and you assume that the dividend and the shareholder and the share buybacks are going to be at the 2019 levels, probably in 2022, 2023, then you get a yield of 14%, which I think they are paying everything out of the business. They are just making maintenance CapEx, right? And then the assets are conventional. Well, Lukoil has recently been moving towards tight oil, a little bit of it, and a bit of shale, which the shale in Russia is a bit better than in the US because of the royalties and other considerations as well. So Lukoil has better assets with low decline rates. Okay, the number of years of 1P reserves is 18 years. So you have
That's almost double the number of reserve years that a lot of majors have, I think, right?
correct.
Yeah,
Correct.
that's a lot.
And you have to take into account that this assessment was done with very low oil prices. So basically, for all practical purposes, Lukoil reserves are infinite. I mean, in the sense that it's probably 25, 30 years, I mean, who cares, right?
Right. You mean like in the same sense that like all reserves of oil companies are a bit understated in that if prices rise, you know, they would count a lot more
exactly.
barrels? Okay, sure. But then
Exactly.
if you have a huge reserve base, then that adjustment is also going to be huge.
Okay, so they produce 2.3 million barrels of oil equivalent. Most of it is oil, more than 75%, which is a nice mix, right? And then they also have 1.5 million barrels in refining capacity. Lukoil's refining capacity is very good for Russian standards and for European standards, but not for US standards. So when you compare Lukoil's refining footprint against Suncor or Imperial or Exxon, it's subpar. But because it's mostly a regional business, it's also nice piece
and
of
if you're a great refiner, you can mix like more complicated fuels, and that usually you get a better price. You can be more flexible. If one fuel gets a high price, you can make that. And
exactly, you have more flexibility with the differentials, right? But it also means that if the differentials are very low, right, it means that the original capex you put into the refinery, it's not going to pay off because. So it's a difficult decision to make. Overall, I would say that Lukoil's refining business has been quite good, right? And for me, it's very important to find an oil company, right, that has both businesses, right? In these cases, 1 + 1 is not 2; it's more than 2, right? I mean, I've seen so many good businesses, many of them in the North Sea, just with upstream exposure. When oil prices go down, then they are in trouble. If they had a refining business, then they could, to some extent, right, to stabilize the upstream business, and that's really valuable, right? So many. I mean, when you look at Suncor and Imperial Oil, that has been the story over the last 5 years, right?
okay.
The reason why they've been able to generate at least some cash flow, right? So you don't have that problem. The problem with Corona, of course, it's been a double whammy, right? Your upstream sector is going to be impacted, but also your downstream because you are not operating at optimal capacity rates, utilization rates. Sorry. So and finally, Lukoil, when you look at the last over the last decade, they have been obtaining a 13% return on net operating assets unlevered. Okay, and it has been very stable because the tax system in Russia encourages that kind of stability. Okay, so it has been 13% higher than the Canadian players, a little bit less than Exxon, right? But much more stable. And the nice thing about it with no debt is that Lukoil right now is trading at 0.7 times net operating assets. Okay, so if you think that they are going to obtain in the future 13% still return on net operating assets, they should be trading at around something like 1.3, 1.4. So it's a double from current levels, right? Of course, I don't have any expectation that Lukoil probably will ever trade higher than 1 times EV/NOA, right? When you look at history, Lukoil has always traded at a discount, right?
Yeah.
And I expect that that's going to be the case. I don't expect any miracle. And that's why it's the shareholder, the capital allocation policy, right? It's very important because if the stock doesn't revaluate with capital gains, at least you have a very high dividend yield, and then this is what what you are getting. So I expect on average that if oil prices go back to 50, 55, we don't need more, right? They generate good returns with 55, right? Because at 55 they have to pay very low Russian taxes, right? I think this is probably a 16% unlevered return going forward.
Okay, so if I can summarize a little bit, this is very safe because there's no debt. It actually generates good returns on the capital that it invests. It doesn't trade it trades at a low multiple, and it always has, but you're not counting on that improving. Are you getting some money like out of it through dividend, or and so maybe a second follow-up why I'm asking? You're aware of the geopolitical risk. That's why they trade at a lower valuation, lower discount, and so you're fairly confident that it's not going to deteriorate much, like that you get your assets seized or something like that. So that's I'm interested in your view on that.
Well, to be honest, I don't have a very good answer about it. Lukoil, a major shareholder, it has been a major shareholder for very long. Mm-hmm. Okay, it has been an oligarch, I would say, and with obviously very good connections to Putin, because it cannot be otherwise, right?
It is. I mean, that is the case with a lot of larger Russian companies.
Yeah. He was a very important figure in the communist transition, because he was previously the Ministry of Energy, and he was the one who brought to Russia the idea that you must have oil majors with integrated operations. I mean, we must have Exxons and Chevrons of the world in order to compete with the Western expertise. Okay, over the years, the Russian industry has developed its own expertise. So most of the contractors of Lukoil are Russian players. So it gives them a bit of leverage in terms of pricing, of course. But it also gives them the flexibility not to rely on Schlumberger or Halliburton or any of these guys in case deteriorations like it happened in Venezuela, right? That you have, and then Halliburton has to go out of the country, and then you don't have any expertise, okay, to develop your fields. That's not going to happen to Lukoil, right? And the second thing I told you, which is very important for Lukoil, and actually I forgot to mention, is that it's a dollar business, right? Because it sells barrels of oil, right? Mm-hmm. Which is a dollar market.
Yeah.
But more than 50%, I'm talking out of my mind, so by heart. Sure. I mean, so I think more than 50% of its costs are in rubles, right? So it means that when there is a geopolitical tension or where oil prices go down, mm-hmm. the ruble depreciates. And that's very good news for Lukoil. And that's the other reason why the returns have been so stable. You have very nice operations with a management that has been fairly reasonable, I would say, allocating capital. On top of that, you have the Russian tax system, which caps your upside, but also your downside. And on top of that, you have the ruble, right? Which I think it's game changing.
Cool. So this that gives it a very stable earning stream, and that's so interesting because energy is very pro-cyclical, and then that's cool. And
as you know, you have the same thing to some extent with the Canadian players, right?
Oh right, yeah. Well, I haven't ever looked at that, but it's should check that out probably. Let's see, maybe. And what are your thoughts on like the oil price, or you're just assuming if it stays like this, that's okay, but it probably gets to 55 or what are your views and what time frames are you thinking about?
Well, it's very difficult because the oil story over the last decade, it has been a story of supply, right? Mm-hmm. That at some point we didn't have enough supply, and then later we had more than enough supply, right?
Yeah, it's a lot of shale. Like the shale is coming on so
Exactly.
quickly, and they turn it down, and then it's back up, and like that. And there's no more like big upswings.
Exactly. And then you have the Canadians, of course, ramping up production over the decade, which is a very stable and sticky production. Uh, but now it's a demand situation, and here when you look at fundamentals is much harder to say, right? Because when you look at supply, I mean, every oil bull has been wrong, right? That they have been looking to this kind of, I mean, Haber models, right? Saying, okay, this is going to be the decline of oil per year, and they were right, right? But they didn't take into account technological advances. The problem with demand, of course, it depends on a lot of things, and it's not so deterministic, I would say. I would think that by the end of next year, right, we should have much more clarity, right, to see whether vaccines have worked or not. Okay, to see the scares of the economic depression. I mean, the derivative effects. I mean, there are a lot of things still to a bit earlier, and that's the other reason I invested in Lukoil, because when you have a balance sheet, right, then you can afford the luxury of waiting for the recovery, right? You are sitting on a very nice yield. And just that, I mean, I've been following the oil market for the last 4 years, and very in depth, I would say. So I don't spend any longer more time in predicting whether the oil market is going to be in balance next quarter or 2 quarters. I mean,
Yeah.
I don't know.
So yeah, you get survival out of the great balance sheets that you pick, and
Exactly.
then you have the patience, yeah, or the patience of the ability to wait for when the price spikes come. And unfortunately, for oil investors, that's taking longer than we would have expected like 5 years ago. Um, and then I noticed you made quite a few energy investments in the crash of 2020. And you were like very forthright about that you regretted some of your moves. And can you tell us about those? Because it was super interesting to learn from each other's mistakes or failed investments. Yeah.
Sure. One mistake was California Resources. What's probably you are very aware of it, because it's trending topic always in Seeking Alpha, this company,
Okay.
right?
I actually didn't know it well.
Yes, so
But,
it's CRC. It's a conventional producer based in California, right? It was a spun off in 2014, I think, right, with from Occidental, with a ton of debt, and of course they were very unlucky, right? When you are spun off in 2014, and then you have the oil down cycle, and you cannot do anything. It's impossible, right? Their assets are okay. They are not top notch, but I would say they are better than shale, right? So in a $65-70 environment, they could make it. Okay. The management team was promising that they were going to sell assets. They had some non-core assets, real estate, some midstream assets that I guess they could have fetched a nice valuation for them, right?
mm-hmm.
And still retain the core operations. But I mean, year after year after year, I mean, we arrived to 2020. They are still high lever, right? The bonds collapsed, and at that point we bought CRC bonds at 35 cents on the dollar, the second liens, right? Because at that point as well, they offer a restructuring of the debt, saying that basically, I mean, if you have second liens, then you could convert those second liens to a royalty asset on L Hills, which is CRC major asset, right? Which we very much like it, because we thought, I mean, a royalty, I mean, L Hills is going to keep producing for decades, right?
Yeah, I
And
love
I think
royalties.
exactly we are the top of the stack of the capital structure, okay? And on top of that, I think the coupon was 9%, something like that, right? But because you were buying the second liens at a discount, I mean, it worked something like a 15% yield, which we thought was reasonable, right? So we decided to buy some second lien bonds. Then you had the Corona crash and the OPEC, right? Lack of agreement. The crude collapsed, and the company decided to retire their offer, right? So we basically had now a second lien bond that in theory, in a normal environment, I would say it was worth quite a bit, but not at that point in time. So, it was basically a write-off.
Cool. So there was like a special situation. There was an offer on the table, and it was an offer you liked a lot, and it sounds great. And then it was, withdrawn, which sometimes happens. And then you're very often, as I know really well, stuck with something that's not worth so much anymore. So okay, that's interesting. Let's see. Do you have any other like great energy investments, or shall we switch to some of your other investments?
No, right now it's just Lukoil, and as I said, in the coal space, Alliance Resource, which is a great company. I mean, it's very hard to find better management than Alliance. It's something incredible, to be honest. And then Consol, which
makes them so great? People have different ideas of what makes management great, so I'm always curious.
Well, I would say as they are owner operators, which I know it's a much used catch, but in this case it's true, right? They have a substantial part of their wealth invested in the business, okay? And when you look at the historical track record in terms of distributions and the return on capital employed for such a cyclical business such as coal, right? It has been incredible. I would say that I've never found a company better managed than Alliance when you look purely at the numbers, right? They have been able to create a very flexible cost structure. I mean, when you look at their performance during the COVID crash, they have been able to idle some mines. They have been very flexible in cost, and so far, in the worst year in the history of the coal industry, they have been able to generate some free cash flow. Of course, because of working capital, and there are some tricks, right? But even so, it has been incredible, right? And now they are able to ramp up production very quickly, right? So this is a production. I mean, this is a name that we really like, and that we think that the bonds maturing in 2025 or 2023, I don't remember right now. I mean, they provide a very nice opportunity. They are paying something like a 16% yield or something like that.
Wow.
Which I think is great.
And this is another company, because I mean, when you invest in equity, you pick companies without much debt. Does this one, when you go into the debt yourself, do you care about how levered it is, or is it less of a concern?
No, yes, leverage is always a concern.
Okay.
And especially in coal, where your margin of safety is always so small. Okay. In this case, both in the case of Consol and Alliance, I think we have found players that they are going to be the last players, the survivors.
Yeah.
The last tons of coal that are going to produce in the US are going to be by either one of these players. I'm pretty sure about it.
Okay, interesting.